Hey everyone, it is Julie here with TipRanks, and today we're taking a look at recent stock upgrades and downgrades from a 5-star analyst. So let's get into it. Alright guys, welcome back. Thank you all so much for being here and happy Friday. Today I was perusing the daily analyst ratings over on TipRanks and noticed we had quite a few updates coming from one 5-star analyst. That analyst is Eric Sheridan from Goldman Sachs. He's currently rated 5 stars and ranked number 230 out of over 8,600 Wall Street analysts, putting him in the top few percent. And just today you can see he's updated a big list of his stock coverage, and this includes buys, holds, and sells. And while many of the ratings were reiterated, we do have a handful that were either upgraded or downgraded. So we're going to take a look at a few of these stocks that jumped out to me and see some of the reasonings behind his changed rating, and of course how the rest of Wall Street weighs in. You can follow along over on TipRanks or by downloading the TipRanks mobile app using the links in the description down below. Now let's dive right in. One of the first that caught my eye was a downgraded rating on Duolingo. He changed his rating to a sell after having hold ratings on the stock over the past year. Duolingo is the mobile app to help users learn different languages. Trading under the ticker DUOL, they're currently priced just shy of $190 per share. They saw phenomenal growth in the past year, up 124%. Year to date, they've been cooling off and are currently down 16%. That past year of growth has been supported by a great upwards trend in their earnings. Looking at the past couple of years, you can see a solid trend of earnings beats and upward growth to positive earnings per share. Their next quarter is coming up on February 28th, where analysts are anticipating earnings per share of 6 cents, and that is a big increase over last year's loss per share of 35 cents. But our Goldman Sachs analyst, Eric, did just downgrade the stock to a sell. He sees artificial intelligence as a potential headwind in the coming years. And this is given the company's weaker platform moat and adverse shifts in consumer enterprise spending trends. The sell rating reflects the current risk-reward skew on the shares after their big rally in 2023. While Eric is currently the only analyst with a sell rating on the Duolingo stock, our other most recent ratings have come in as holds. The average price target for the stock comes in at $194, which would be a slight upside of over 2%. Down below, we can see Eric's rating here with a downside of over 15%. Prior to that, we have a hold from Bank of America with a bit more of a bullish price target at 21% upside, and another hold from Barclays with a downside of over 8%. Going back beyond that, we have a couple buy ratings on the stock still as well. Eric also just downgraded a similar stock for similar reasons, and that is Coursera. This is another stock that he previously had rated a hold throughout the year and just downgraded to a sell with a downside of over 20%. They trade under the ticker COUR, currently priced at $17.48 after dropping over 10% today. They did see growth of 29% in the past year, cooling off here year to date. Some of that downward pressure on the stock today has been spurred by news of the downgraded rating. Similar to Duolingo, they see artificial intelligence as being a potential headwind. The firm modestly lowers revenue assumptions for Coursera to reflect weaker enterprise revenues and reduced operating margin assumptions to reflect lower enterprise estimates. Coursera will be reporting their Q4 earnings report in a couple of weeks on February 1st. Where analysts will be anticipating a neutral earnings per share of $0. This compares to last year's loss per share of 4 cents. Coursera has yet to break into the positive earnings. Eric's sell rating is the only analyst rating so far in January, and the rest do come in as buys or holds. With 11 buy ratings and 3 holds, the average price target of $22 would be an upside of 26%. Down below, we can see Eric's rating here with that downside around 20%. The most recent rating before that was back before Christmas from Morgan Stanley with an upside of 37%, and plenty of other price targets back in October in the double digits. So we'll see how these change after that next earnings. Now, it's not all doom and gloom with downgraded sell ratings. Eric did feel bullish enough on one company to upgrade their rating to a buy. And that upgrade came in on Fiverr International. He upgraded the rating to a buy with a price target that would be an upside of 66%. Notably, he does have a 100% success rating on the Fiverr stock, which he previously rated a hold. Fiverr is an e-commerce platform that allows people to buy and sell digital services. Trading under the ticker FVRR, they're currently priced just shy of 26% and are up nearly 5% today, though the stock did lose over 23% in the past year. Now, despite being in the red this past year, Fiverr is another company whose earnings and revenue have seen a nice upwards trend. They've seen upward growth in both their revenue and earnings here, and have beaten expectations pretty consistently here for the last couple of years. Their next earnings report will be coming out on February 21st, where analysts are anticipating earnings per share of 48 cents, nearly double the previous year. So, upgrading his hold to a buy rating, it seems Eric thinks that the Fiverr stock is finally due for some green. He sees continued re-acceleration of revenue in 2024 driven by a stabilizing macro environment and expects the company's net adds to improve through the year. Goldman Sachs sees spend per buyer growth, international progress, and continued promoted listing and seller plus adoption over time for Fiverr. And analysts seem to be more on the same page with the Fiverr stock. It does currently have 7 buy ratings and 2 holds. And the average price target of $36.78 would be an upside potential of nearly 42%. Most recently here, we do have Eric's price target with that 66% upside, several others in the 50% plus upside, and the low end we do have a hold from RBC, still with an upside of nearly 16%. There is another rating by Eric that caught my eye, as it's another stock that he has a 100% success rating on. And that is on TTWO. He reiterated his buy rating with a price target of $200, and his last rating did come back in August. If we zoom out a little bit here, we can see he previously had a whole rating and upgraded it to a buy back in October of 2022. TTWO is a software developer and the name behind popular games such as Grand Theft Auto. Trading under the ticker TTWO, they're currently priced at $161 per share. They have seen growth of over 51% in the last year, including 15% in the last 3 months. Now, TTWO's earnings have not been as consistent. Looking at the charts here, we can see some ups and downs in those earnings. In the next report on February 8th, analysts are looking for earnings per share of 72 cents, which will be a slight decline from last year's. And down below, we can see they have had some earnings reports where they've fallen short of expectations. But the big buzz surrounding Take-Two Interactive is the highly anticipated upcoming release of Grand Theft Auto 6. And while we didn't get commentary with Eric's recent rating, we did also hear from BMO Capital analyst Brian Pitts. The analyst says that the company's Grand Theft Auto is among the largest and most profitable entertainment franchises in history, and the setup for GTA 6 looks exceptional as console sales surge after COVID-19 era supply chain issues were resolved. They think that GTA 6 could sell 30 million units in calendar Q1 of 2025. The stock has gathered a decent amount of attention from Wall Street analysts, with 19 current analyst ratings coming in with 17 buys and 2 holds. The average price target comes in at $173 for an upside potential of nearly 7%. And our most recent rating just from today is Eric with his price target of $200, which would be an upside of 23%, and BMO Capital coming in with the same. Looking down below here on the low end, we do have some older ratings, including a hold back in December with an upside of 5%. Now, there is a long list of other stocks that Eric just recently reiterated price targets on. I think he updated about 20 price targets today. So if you want to see more of those, head on over to his page over on TipRanks. I'd go through more, but we would just be here all day. So that was just a quick look at a few that caught my eye with those upgrades and downgrades and pretty high success ratings. Let me know your thoughts on these stocks in the comments down below, whether you agree with Eric or not. I always appreciate hearing from you guys. Thanks so much for watching, and have a fabulous weekend.